All right. Good morning, everyone, and good afternoon to those of you who are joining us from Europe, and a very good early good morning to those joining us from the West Coast, and anybody on the line who's joining us from Asia. Good evening. So thank you all for being here today. I'm very excited to have this conversation. We're coming off the heels of COP-26 last week in Glasgow, and we just have a wonderful panel of experts here today who are all in Glasgow and who are going to share some of their impressions on the outcomes of the conference, and really their perspectives, particularly as it relates to the transition to the net zero economy and how to finance that. So this is a topic that the Bretton Woods Committee's new Future of Finance Working Group will be exploring in depth in the upcoming year. So we're using this conversation as a springboard of sorts into that work. So I'm really looking forward to hearing from our panel today. So before we turn it over to them, just a couple of quick notes for the audience. We will reserve some time at the end for audience questions. If you have a question, we ask that you please send it in using the Q&A function in Zoom. We'll collect these and then we will unmute individuals when it's time for Q&A. If you do submit a question, please remain on standby so you can unmute your microphone when you are called on. And I know that one of our speakers has to leave promptly at 10 a.m. today. We'll try to get to audience questions before then, but if not, you can email your questions in and we will pass those along. So now just a quick introduction of our speakers. We have with us today Mr. Kenneth Lay, who is the Senior Managing Director of the Rock Creek Group and previously was the Treasurer of the World Bank. We also have Vivek Patak, who is the Global Head and Director of Climate Business at the International Finance Corporation, where he facilitates all of IFC's work related to climate. Veronica Scotti is the Chairperson of Public Sector Solutions at the Swiss Re Group. And Veronica is also a member of BWC's Advisory Council. So Veronica, I very much appreciate your leadership, especially in this space related to climate and sustainability. We also have with us Ann Simpson, who is CalPER's Managing Investment Director for Board Governance and Sustainability. She serves on the Board Investment Committee and also leads CalPER's Sustainable Investment Strategy. So fantastic group of experts who we will hear from today. And moderating today's conversation is Mario Koivisto, who is the Director of ESG at P Capital Partners. She was a World Economic Forum Fellow and also spent time at the World Bank. So thank you all again for joining us. And Mario, I will turn it over to you to get the conversation started.
Thank you, Emily, and welcome everyone to this discussion following those very intense and busy and exciting weeks and negotiations in Glasgow at COP26. I guess the discussion that we have today with our great experts pertains to the feasibility to the path to net zero and really decarbonization within different sectors and different parts of the world. I think it is safe to say that there was much that was achieved at Glasgow this year, but also, of course, much that remains to be done by way of working on global challenges on climate finance. Of course, for the first time, the reduction in fossil fuel subsidies and in coal was written in the final text. As well as there was a recommendation made in doubling of climate finance for developing economies. And our experts, of course, have much experience and insight in terms of these areas and what the multilateral system can also deliver on these goals. Yet there were other areas around climate finance that remain to be accelerated. Some of these have to do with agreements around carbon trading and a number of different agreed upon principles around carbon markets. Instead of deep diving into those issues right now, what I'd like to invite our speakers to do is to give a brief introductory statement based on their experiences of having participated in a number of public and private sector collaborations that took place in Glasgow this year. So without any further ado, I'd like to hand the floor over to first Vivek, then Veronica, then Kenneth, and finally to Anne to give a few brief remarks or around 2 to 4 minutes. So over to you, Vivek, to start off.
Well, thanks so much. Good morning, good evening, good afternoon to all of you all, and good to see so many familiar faces that some of you all I met in Glasgow. This was my first COP. I went there with my CEO, and I was there for the full 14 days, actually. A bit tired. I went there with my CEO, Maktar. He was at the COP in 2016, and he made a very interesting observation. He said 5 years ago, it was all about the public sector. It was all about governments. It was all about advocacy. It was even being questioned, is this for real? This time, it was all about the private sector. Private capital has to come in. Yes, the negotiations were on, that was separate, but what was heartening from my perspective was that the private sector was front and central to the solutions. Now, obviously, a lot of people made commitments. I am a person who loves to lead between the lines. I want to see what exactly that means. So phasing down, phasing out, all that's fine, but we really need to start now looking at the fine print and who's going to do what there. So two things I want to say. One is we need to stop this rhetoric of we're saving the planet. My new line is the planet has survived for 1 billion years or billions of years, and the planet will survive for billions of years. The dinosaurs didn't survive. So is the human race going to be the next dinosaur? So that's really the way I'm looking at it. And what sort of life will my 12-year-old daughter have, and will she ever have kids who will survive? So I think it's important that we understand this is about ourselves. This is not about the planet in general. So that's one. But having said that, I think the good news was people, I hope, will be held accountable for what they're seeing. I believe in transparency. I would love to see, for all the people, the WEF Alliance that you talked about, Veronica, who's doing what today. Because when I read between people's results today, there's still a lot of money being made in the fossil fuel sector. And that's not a crime. I think that's fine. There's still a lot of exposure. It's not coming down. And the one thing I want to say is that we cannot risk solving the climate problem and having an inequality or a social problem. Because when we talk about getting countries to exit from coal and fossil fuels, we need to make sure it's done in a fair manner. It's done in a way that employment is created for those who lose their jobs, and that we reskill those people so that they are gainfully employed. And it's done in a way that a certain part of the population doesn't get left behind. Sorry. So with that, thank you very much, and let me pass it back to you. Thanks.
Thank you very much, Vivek. Lots of food for thought. Without further ado, over to you, Veronica, for your thoughts.
Thanks, Marjan. I hope you can hear me, Mario?
Very well.
Okay, fantastic. Well, so let me build a little bit on what Vivek just said. So I think the COP was not perfect, but demonstrated really important progress. And it has brought about some new pledges. So I kind of have two things that I think worked well and two things that really did not work well. And what overall did not work well is that as we stand today, we are still expected to miss the Paris 1.5 degree target. So that we should all be concerned, as Vivek said, for ourselves first and foremost. But maybe leading with the positive, there is clearly this momentum building, and the peer pressure, both across the aisle from the private to the public sector, will help accelerate the transition. Of that, I'm convinced. And I think it's exactly this pressure, maintaining this pressure, that will give us a chance to get back on track. Also very positive, for me at least, is the Glasgow Climate Pact, because it's the first time that 197 countries have adopted it. There are rules still to be, fine printed, but for carbon markets. And it's also the first time that we explicitly plan to reduce coal. Not completely phasing it out, I guess that's the downside. But what we need also as a positive is the fact that we are now setting the expectation for all countries to increase their ambitions 1 year from now instead of 2025. So this momentum is a very positive item. I want to maybe hint on two concerns that I still have coming out of the discussions. First of all, the pledges do not unambiguously put the world on a sustainable carbon reduction trajectory. And if we just take the 2030 timeline, for instance, we know that the global emissions will still be double than the level that is needed. And we are on a course of 2.4 rather than any reduction by the end of the century. And amongst the top 10 greenhouse gas emitters, China, US, and India did not sign up to the pledge to transition from coal out of coal by 2050. China, India, and Russia did not join the methane pledge. So and Iran altogether has not signed up to the Paris Agreement. So I think that's also something that should cause us to reflect. And based on all the nationally determined contribution targets, the global greenhouse emission are forecasted to increase by 13.7% by 2030, relative to the baseline of 2010, instead of a 45% reduction, which is what the targets should reduce or are required for us to be on track to the 1.5. Then the final comment, and again, it's maybe more sobering, is that if history is any guide, these pledges may not materialize at all. And that is because all top 10 greenhouse gas emitters targets have actually not achieved what they committed to even in 2020. So the climate tracker for climate action trackers, for those that care, actually posits that no single country has short-term policies that are sufficient to hit the net zero target, which is why I think it's so important that we take stock of the good progress and the commitments and the pledges, but we really amp up on the execution and the accountability front. And with that, maybe I want to hand it over to the next speaker.
Great, thank you, Veronica. Lots of interesting thoughts there, and also a nice positive note around the momentum that was achieved. But over to you, Kenneth, for your experience.
Yeah, thank you. And I'm going to build a little on what both Vivek and Veronica have said. My sense of this was the second of these that I've attended, and it was good to see the sense of what I think is a greater sense of urgency than I had experienced with this in the past. And this was obviously driven by some of the climate-related events over the past year or two. I think this also had led to a greater focus on adaptation, which I think was very important in a lot of the discussion around this issue. And I very much take Vivek's point that we don't want to end up being the next group of dinosaurs, but in order for us to avoid that, I think it's going to be both mitigation and adaptation. So it was very good to see that coming. On the private sector front, it was great to see that as well, a much more extensive engagement. Of course, the so-called GFANS initiative with 130 trillion of capital got a lot of emphasis. But I think, again, here, as both of the earlier commentators had remarked, I think the implementation is going to be key. I continue, and I'll be interested in what Anne has to say on this, I continue to be concerned that a very substantial part of the institutional asset owners still do not have clarity around how to balance their perceived fiduciary responsibilities for their beneficiaries with the importance of the type of climate mitigation and adaptation investments that we need to make. And I'm hopeful, I guess where I'm hopeful is that the sense I had was that we're getting closer to having clarity in regulatory structures around all of this. And I think we can talk about it some more so that we can perhaps clarify that. I know that in Anne's organization, of course, has been on the front lines of all of this, which is great. I think there's a lot of opportunity to get this message out more broadly so that we really can mobilize the capital that we're going to need. On the implementation issue, this remains crucial. And I would observe, I mean, we had the methane phase out discussion, we had the coal phase down discussion, all of that. However, I cannot resist noting that in something else I was looking at just yesterday, the United States government is still doing oil and gas leasing on public lands. there are at least one and perhaps more states who will seek to enjoin the government from measures that the federal government from measures that it was going to take to reduce methane, things like that. And I think this illustrates this tremendous issue that we have with respect to implementation of the agreements that come out of the COP. But I'll stop there. And we can hear from Anne.
Thanks a lot, Ken. Appreciate that, and lots of interesting insight there around also private sector participation in these discussions and this need for alignment in order to get capital mobilized to meet some of these goals. Anne, wonderful to have you join us for the discussion. Over to you for your initial remarks.
Well, thank you very much, and also Vivek, Veronica, and Kenneth have really set out some important comments. Just to build on what they've said, and really focus on the practical side of this. I was also there for 2 weeks. I was there as a delegate, so I was able to be close to or alongside many of the discussions. Coming out of COP, there has to be a positive message about what we, excuse me, could and should be doing to get ourselves from, at best the 2.4 degrees global warming that we came out of COP. I mean, just sticking with the numbers in a sort of simple way. We went into COP with most of us saying, we're at about 2.8 degrees. The difference between 2.8 degrees and 1.5 is almost an existential gap. And there's even commentary that 1.5 is going to have us in very big trouble. We're at 1.1-ish, and living in California as I do, this does not look like we're in a comfortable place. So I think it's absolutely right to be saying part of the focus needs to be on resilience for investors, which opens up a huge amount of opportunity for us to deploy capital. But the mitigation task is nowhere near where it needs to be. Now, in terms of being practical, on the investor side, I also came out of COP being very clear that we've got 3 tracks of work. There's the work with government, and without policymakers dealing with issues like carbon pricing, removal of subsidies, both of which distort the economics of the transition, and that's a real problem for the financial markets. So it's aligning these incentives, that's one piece. And we sort of tiptoed a little towards that. Well, investors have really got to keep their advocacy clear with policymakers on those 2 points, subsidies being removed, carbon pricing being introduced. The second thing markets need is information. And we're getting distortions in decision-making and a lot of false positives because we don't have a comprehensive set of risk reporting. Now, at COP, there was the announcement of the International Sustainability Standards Board, which CalPERS has supported from the outset. However, our focus really is shifting to the accounts, the accounting and audit track, not the supplementary information that's non-financial. And I think for CalPERS, one of the most important sessions at COP was on accounting and audit. Because if we take the fundamental principles of accounting and think about the role of the accounts, this is a baseline set of information for investors, both in understanding their risks, but also directing capital into the opportunities. So the International Financial Reporting Standards, which are followed by 144 countries, need to be tightened and interpreted very clearly to capture the impact of the transition on companies' financials. And, all praise to Nick Anderson at the International Accounting Standards Board, where he serves as a member. He wrote an important piece a couple of years ago, which has since been picked up in guidance, which is good. setting out how basic measures on impairment, on amortization, really on explaining the assumptions behind the accounts. All of this we could and should be moving on immediately. So I think for the investor community, this means having a focus on auditors, was the big 4 plus 2 really need to raise their game. And I think that investors will be scrutinizing or looking for the precious little we currently have in audit reports around how, whether and how climate risk has been reflected in the numbers, and also audit committee members. So I don't want us to get distracted waiting for a lovely new collection of reporting. We need to really focus both with the SEC for US GAAP and IFRS more broadly, because if we understand truly how financial markets work, they can deploy capital. The financial markets can be the irresistible force to the immovable objects that we seem to face. But without that information and without those incentives being aligned, it will be awkward. Finally, and just to reference how investors are beginning to understand this, is we have understood, I suppose, that we need to work in partnership with each other, because we have to overcome the tragedy of the commons that we face. If you like, we're all victims of modern portfolio theory. We're highly diversified. That makes it very difficult to address systemic risks like climate change or inequality, you know, as Vivek rightly said. So Climate Action 100 Plus is an initiative we convened and now has some $60 trillion lined up. The important thing is how to get that money organized and put to work, because I think the big GFAN statement is great for the shop window. Hey, this is what we're planning. But the real question is, how do we get it done? And we're very much onto the practicalities of that. So what we did was sift out the 100 or more largest greenhouse gas emitters in our portfolios. That was a data-driven exercise. That showed we were focusing on about 80% of our industrial emissions in the portfolio. Out of that group, we've now got 111 companies that have made net zero target commitments. And Bloomberg New Energy Finance calculated right before COP, if we get that relatively small group of companies to meet the net zero target that's been agreed, it's going to be equivalent to about 25% of global emissions. So around almost the annual emissions of China. So what that says is two things. One, we're having trouble with the lack of reporting, but use the data to zoom in on the source of emissions and understand their full life cycle through scope 3. That's one thing. Two, we've got to work in partnership with each other in finance and have a strong role supporting what civil society is calling for with governments and policymakers. But the other thing is we've got to have a benchmark, which we have developed, the Climate Action 100 Plus Net Zero Company benchmark, which integrates the emissions reduction, the alignment of CapEx, accounting and audit, political lobbying, which is still an issue, I have to be honest, and making sure that compensation and rewards inside the company are aligned with these goals. And finally, the just transition. And as part of this benchmark, we've drawn on the International Labour Organization guidelines in this area, and we've built an indicator for the just transition for companies that are beginning to set out their plans, just to make sure that we understand and there's a proper response to the needs of workers, communities, particularly vulnerable communities right through the supply chain. So it can be done, but we need, I think, you know, if we were judging this by statements, we'd be well on our way to success. But it's not what we say, it's what we do. And I think, you know, my fellow panelists have all touched on that in some way. So the action is what matters, you know. My grandmother said, when I was a girl growing up, fine words, butter no parsnips. So we shouldn't get too, what can I say, enthused by the statements. What we should be looking for is the action and the reporting on that. Thanks.
Thank you, Anne, and thank you to all the panelists for such insightful initial remarks. What I'd like to do in the next sort of 25 minutes, and I want to leave some time for questions from the audience as well, is to begin by asking a couple of questions around some of the observations that you've made. I think good points were made around efforts that need to be made within developing economies, but also, of course, within our kind of other global markets. Great points around finance and advances in carbon finance and financial market developments. I think, Anne, thanks for the point around also accounting and audit issues. There were lots of steps forward made there. Based on good previous work, of course, by institutions such as SASB and so on and so forth. But maybe to begin with you, Vivek, you obviously participated also from an IFC perspective, and you work with a lot of companies and entrepreneurs within the global markets. And if we think about partnerships especially, what do you think would be sort of the key steps to accelerate for emerging market companies, especially? What are the sort of efforts that they can really take upon themselves in global value chains to move forward now that the marching orders from COP are a little bit clearer?
Sure, thanks so much. So one is the fact that global value chains are getting greener or decarbonized is a fact of life. And I think we have to try and impress even more upon our clients or our clients in emerging markets, the importance for them to decarbonize, or else they're going to get left behind. It's as simple as that. Yeah. Now, it's very simple. You need capital to decarbonize. So you've got some great technologies today, which can reduce your carbon emissions for steel, cement, a lot of things. You can use hydrogen, but they cost money. The question is, who's going to pay for that really? So it's you know, I'm breaking it down because I've had a lot of conversations, and this is where it comes down to. What gives me hope is that when we look at the solar space 15, 18 years ago, tariffs were high, 26, 28 cents. But over time, with some amount of blended finance, with some amount of improvement in technologies, and with the market expanding and institutions like us going in early, taking some risks, tariffs have come down. I think the last auction we saw in India was down to 2 cents. So this will happen. It'll take time. The question really is, how quickly can we get this capital? And this is profitable money. This is not philanthropic money that I'm necessarily talking about. Yeah. This is money where people are willing to take some amount of risk and saying, this technology is expensive today, so we can use blended finance to bring the cost of capital down a little bit, but somebody has to pay for it at the end of the day. You know, it's like my favorite thing is, this is a decarbonized bottle, and this is a fully brown bottle. This one's going to cost more. So where is that capital going to come from, I think? And that's got to come from multiple sources. Now, the way we have to also look at it is, how can we try and get these technologies out there faster? How can we start greening domestic capital markets or domestic financial sector, the domestic financial sector? Because at the end of the day, you know, I keep telling my good friends in GFANs, the $130 trillion is not going to decarbonize my SMEs, is not going to decarbonize my small companies. And very importantly, I want to put it out there, somebody is going to take currency risk on that. So to me, I think we are a little off. We need to start focusing on greening the domestic financial sector first, because that's how it's going to then sort of permeate through the entire ecosystem. So I think what we are seeing is a higher level of awareness, but I don't think a lot of some governments or some companies have yet recognized the seriousness of not decarbonizing. And that's really what we're trying to do, helping them to understand that even if you're, you know, a third-tier supplier to a Unilever, at some point in time, that's going to get to you. Now, my question then is, what are the principals doing to make it happen? They also need to be willing to put out some amount of capital. See, you can't outsource your entire manufacturing to Asia and tell Asia to decarbonize and you don't do anything about it. And I've had some very difficult conversations on that. And when people say net zero, I want someone to really question them, what does net zero mean? For a very large multinational to go net zero, they need to buy carbon credits equivalent to foresting the entire country of Portugal. So let's see if people are talking reality, or is it, as Greta Thunberg says, blah, blah, blah. Let me end with that.
Thanks, Vivek. And I know that many of you raised this issue around what are the promises around transparency mechanisms. So whether it's to increase, for instance, reporting and accounting for companies around carbon emissions. Scope 3 has been mentioned, and global supply chains transparency is a major issue there. But I think to go to Veronica, because I think you participated in a conversation in a group coordinated by the World Economic Forum that has private sector representation from across industries that have global business. What types of levers and market-based levers do you see for the increase of transparency and other efforts to actually achieve decarbonization within a more sort of global risk and value chain perspective?
Absolutely. And let me build a little bit on what Vivek said, because he's right. The Scope 1 and Scope 2 is completely within our reach. Is when we go to Scope 3 and Scope 4 that things start getting a little bit complicated. And he's absolutely also right. And I'm going to take a slightly different angle, that the large companies are certainly much more visible and under bigger pressure. And so it's not obvious to SMEs, but I would say non-publicly listed companies, that they have also a very important role to play. So I'll try to tackle this quickly, Mario, but I like to cover a few topics. First of all, why I actually believe decarbonization is a strategic business rationale for any company, financial sector, production sector, etc. And then I'll go a little bit into, if you will, the Asset Owner Alliance that you were, and the Climate Leader Alliance that you were hinting to. I think for investors to be able to invest with an appropriate risk return profile in the long term is fundamental. But through embracing decarbonization, we're effectively creating the best conditions for a stable and well-functioning economy and market. And we're getting, if you will, lower volatility, because we're not just changing the businesses per se, but so the exposure to the physical assets, but we're also helping with the S and the G. And the reference to the S and the G is quite actually intuitive, because if we have, in fact, a disorderly transition, some element of decarbonization is going to happen anyway, some transition will happen anyway, I'm convinced. It's just how far we take it. And to what Anne said before and Ken before, if we don't take it far enough, it will be all for nothing. And disorderly transition means social unrest, means a lot of litigation. I'm in the insurance industry, so we are in the business of projecting 10, 20 years out. The climate risk litigation is very much on the rise. 5-fold increase in the last 5 years is going to be a huge theme for the future, and people have to brace for it. And so it's not just about the assets getting stranded, it's about entire businesses coming under question, and this point of, I'm going to say, attribution. You knew that you could do something and you didn't. And this will go towards governments, will go towards private investors, will go towards public investors, will go towards insurance companies as well. So, but even if we have a very orderly transition, I still think we need to expect for the next 10 years or so blips in the market. And the reason is we do not have fully accounted for the externalities of our existing economic models. The one externality that we mentioned already is the carbon price. I think there we have a good guidance, whether you want to go with the IMF indication of $75 per ton or Swiss Re approach, we think it's more $100 to $200. It's clear that the $3 that we see today on the voluntary market doesn't cut it, but you have a market signal, 70, 100, 200, whatever you want to go. It's clear the order of magnitude. The one externality that we've not touched upon today, which I think is going to be major in the next 2 to 3 decades, is actually nature. We're not taking at all into consideration the impact of nature and the fact that we have economic systems that are really dependent on biodiversity and biodiversity services. And this has come under huge threat. and it has codependencies with climate. So the cost of shifting to an a nature-centric economic model is still very fuzzy. Now, coming on to why, therefore, we really need alliances and starting maybe going to the asset, the CEO Climate Leaders Alliance, because we talked already about the GFANs and how the financial sector is getting itself organized. For me, the great significance of the alliance is that it's across sectors and it's really trying to bring up that discipline and mutual accountability and the need to think in value chains. And someone mentioned before, I'm sorry if I can't attribute it right now, but what is the cost of getting that decarbonization? I think Vivek said, how do I move from that type of bottle to the other type of bottle? There is a CapEx needed. Well, the Alliance has done a study and we think on average across sectors about 8%. So it's not huge to think of, but it's just very unequally distributed across that value chain. And so we need to create mechanisms where we afford that 8% additional cost of doing things the right way. But let me maybe mention a little bit why the alliance is important. The Climate Leader Alliance is important. It is spanning across 24 countries, 13 industries. Employees are nearly 9 million employees. Why is that important? If I look at Swiss Re, our employees have a personal carbon footprint that is 6 times bigger than the organization. So imagine if you can mobilize your own employees through corporate responsibility actions. And of course, economies, I'm not going to quote market cap joint, etc. But the thing that really stuck with me when we put it together is the fact that together these 114 companies represent the 3rd largest emitter in the world. So if we use, as we've committed to do, the signals of science-based approach, and we act with very high standard of responsibility, we can and we should be able, through just the alliance, produce carbon reductions by 2030 of 0.6 billion tons, which is today's current emission of Canada, and then 1.6 billion tons, which is what Russia will, that's the range, right, where Russia is. So I think we have to continue on this multi-stakeholder approach, and we have to look precisely at the point of interventions around the value chains so that we can execute it. Of course, having government support and policies is fundamental. And I'll close with the 3 recommendations that we put forward as a sign of we're ready to do it, we're going to do it, but this is what we need from you. We would really love to see anything that is fossil fuel subsidies disappear. We would like any tariff that prevents a much more accelerated development of very low carbon solutions and alternatives from taking market stage. And we absolutely need to make sure that this transition is just, because there will be part of the economies that will suffer. So we need to create the mechanism for that support. And of course, we would expect all governments like us to correctly price the cost of carbon, because it's one of the fundamental levers that we really have to internalize in our decision making. I'll pause here because I know I went a bit long.
Thanks, Vivek. Thanks, Veronica. I see Vivek raised his hand too. Please.
Sorry, I just couldn't help reacting to that. So I'm going to make it a bit controversial. 3 things I want to say. One is, this makes good business sense. I'm not an activist. I'm here to make money for IFC. I will encourage people. I'm very clear that what we do has to make good business sense. It may not be making good business sense in the short term, but investing in green buildings is not, for me, climate. It's just good common business sense. And for most things, decarbonization means reducing your energy cost. So over time, and I say over time, it's not after I'm dead and gone, it has to make good business sense. And that's the message we need to get out there. The second thing I want to say is that everybody is asking what others should do. IFC, we operate, and Ken will tell you, the World Bank, we operate in emerging markets which need more energy than anybody else. We exited coal 10 years ago. I want to put this question out there to these different alliances that have been created. What is their exposure to fossil fuels today? And I think they need to be called out, because everyone's coming out. These grand alliances are coming out. I read the fine print. I stay up till midnight. I read the fine print. And that is what troubles me today about what's happening. You know, when I said I've got 80 reasons to be optimistic, 20% of me is a bit pessimistic. And then it's not about stopping it. It has to be a transition, like I said. So sorry, I couldn't help but comment on that there. But eventually what I want to reiterate is 80% of what we do collectively has to make money. It is not a common good. It has to make money. Some of it may be higher risk, so hopefully we get higher returns. Some of it may require a bit of philanthropic capital earlier on to make it viable, but it has to make good business sense. Thank you.
Thanks, Vivek. And I think that that point is really well made, that perhaps we are finally at a point in our economies where the commercial incentives as well as doing good are fully aligned. And with that, I actually want to go to Ken and ask him to perhaps offer your views a little bit around this question around exposure to potential kind of sunk cost or risky asset in consequence of industries that are not being decarbonizing. So should we expect that the decisions made at COP-26 actually either for that reason or for other reasons increase volatility and risk in certain sectors in the financial markets?
I don't think that per se they do. I think a lot of this is going to be how the various players move toward implementation or not, because it doesn't. That's where the uncertainty, I think, arises in this entire process. What policies are going to flow from, specific policies are going to flow. I think it's worth coming back on. I think one of the things that really needs to happen in all of these areas, and this gets to the point that Vivek was just making and that Veronica made about, for example, natural capital. We are going to have to come up with ways to, and by the way, it also gets to the issue that Anne raised about accounting. We need to make visible both the costs of various of our activities, as well as the avoided cost that can be realized if we move in the right direction on these things. And Vivek makes a point. The obvious one is energy efficiency. Of course, you can quantify the reduced costs of your energy to support financing energy efficiency measures, things like that. But I think being able to make these things visible so that Anne's colleagues at CalPERS can actually incorporate them into the much maligned modern portfolio theory, and that they can begin to be incorporated, because I know so many of the investors and asset owners in particular that I have been acquainted with simply have not gotten to that point. They still are locked into modern portfolio theory. They can't figure out how to incorporate in that the costs and benefits of various ESG related, if I can use it broadly, ESG related measures. And that has, I just see that still standing in the way of a lot of movement in this area. But to come back on the point, I don't see implicit increases in volatility until we start getting to the point of implementation. I use the example on the methane front, or whether or not, the Biden administration is going to suspend oil and gas leasing on public land. Well, that's going to have an impact on petroleum, oil and gas prices, things like that. It causes, I think it can end up creating a great deal of political pushback, which gets in the way of the kind of moves that we really need to make. So I'll stop there.
Thanks, Ken. And you raised, I think, some important points. And I think that I want to go back to what you said about this disclosure and transparency initiatives that were launched at COP26, and go to you, Anne, and sort of, could you break it down for us in sort of layperson terms, that what is the real achievement in the establishment of the International Sustainability Standards Board at COP26? Why do you think that it's so significant for all players involved now going forward?
Yeah, so just for those who may not, who've got lost in the acronyms in the alphabet soup, the International Sustainability Standards Board that was announced in during the COP26 proceedings is a new part of the overall international financial reporting standards architecture, which includes the International Accounting Standards Board. Now, the importance, to your good question, why does that matter? Two reasons. The first is it's acknowledging that sustainability is a financial issue that's going to affect the company's financial condition, and therefore information on issues like climate change, which we're talking about today, but equally we could be talking about human capital management issues. The way CalPERS frames all of this, and has done for some time, is to say there are not one, but there are three forms of capital that we need to have effectively managed by companies to produce long-term value. Financial capital, yes, that's the work of the International Accounting Standards Board, but there is human capital and natural capital, without which we won't get the financial returns that we need. So rather than thinking about this as ESG, which doesn't easily lend itself into a financial model, we redefined our approach on investment for the total portfolio for all asset classes with this three forms of capital measure. Now, what follows from that is you therefore need reporting on the management of those three forms of capital. So the International Accounting Standards Board, the financial capital part obviously belongs to them, but now there is a parallel body within that IFRS architecture, which is going to be looking at, we would say, the human and the natural capital elements of reporting. What is material to the results of the company? Then you might ask, where was the SEC? Because the United States doesn't follow IFRS, follows US GAAP, generally accepted accounting principles. There have been wide-ranging discussions at the SEC with Gary Gensler and the new chair and his team. And we are expecting rule writing from the SEC on climate change, risks, but also on human capital management. So all of this work together is taking us out of the ad hocery, the well-intentioned many frameworks that have been flying around, draws it together. And ultimately, our dream of a common language here is that we have globally integrated reporting on financial, human, and natural capital into the accounts. And at the moment, this is all very disconnected. So I think we're getting a lot of false positives. The other thing I want to mention is private markets, because certainly in the United States, and a number of other markets as well, these frameworks are being put forward for public markets, which is only one part of the story. And one of the things we've seen as an investor is assets being shared out of public markets, going into private markets where they are out of sight, but for us, not out of mind. So the other practical initiative I want to flag and invite people to learn more about or get involved is a private equity data convergence platform that we've launched with an initial group of 4 trillion in private markets. This is to develop the climate change, the human capital measures to support the financial analysis that we're doing. Now, this will include greenhouse gas emissions, but also net jobs created, diversity, health and safety, and some other measures. So we don't want to peel climate change off as a separate topic. And I think Veronica said this, as did Vivek and Kenneth at various points. We've got to have this holistic approach where we understand financial sustainability, because we're a pension fund. You know, we're pushing out $25 billion a year in benefits every year now. And we've also got to grow the fund by 6.8% over decades to come. So the financial sustainability has got to be brought into this. Then the human capital and the natural capital. So when we're talking about climate change, and even with the Climate Action 100 plus net zero company benchmark, there's a mouthful. The reason that we have emissions reduction targets, which are time bound, and financial analysis on CapEx, and the just transition, and political lobbying, is we've got to have this integrated approach to understanding what change looks like. The final thing I just wanted to add is we've got to understand sequence. and I think Veronica said codependency, but it's certainly interdependency. So one of the things that we're doing with Climate Action 100 Plus is building out sector strategies. We've just published steel. We've covered transport, automotives, airlines, utilities. We've got other sectors to do, agriculture, cement, and so forth. Because even when we're investing into the new economy, we are still obviously going to need energy supplies, but we're also going to need steel, and we're going to need cement and shipping. So when you look at this list and people say, divest from fossil fuels, and why do you own the fossil fuel industries? This is simply the supply side of energy. So those who've sold their shares in, say, oil and gas, that is obviously their right and privilege to do so, but they still are owning 80% of the emissions in the rest of their portfolio. So as Bernard Mio puts it beautifully at CDPQ, even when we're investing in wind turbines, you're still investing in cement, in steel, and the shipping to get the facilities installed offshore. So the problem, I think, about greenwashing or ESG washing, which is a theme for companies, is also a theme for investors. So this issue of transparency, accountability, practical plans, and reporting on progress year by year is extremely important. So source for the gooses, source for the gander, all of this reporting needs to apply to the investor community as well.
Couldn't agree more. And also we work in investing in private credit in the private market. So great to hear to make the point that it's not only disclosure within the public markets, but also really bringing that forward within the SME sectors around the world. It's great. Veronica, I think you wanted to respond as well.
I wanted to build on what Anne said, because she made some really excellent points. I'm sorry if I'm repeating, but I think it's so important to bring attention to this. So first of all, what I would echo, maybe my own words, is the importance in the next few years to really think not just in passive, because I thought there are some questions, not in terms of just passive investment, but really think thematic investments. For us as an organization, this is really critical. And why is that? It's because the value pools are going to shift very, very quickly in the next few years. And this shocks, right? We need to be able to anticipate and understand in order to make long-term investments. The second thing I want to build on is, again, the point that Anne made on what happens, the decarbonization needs to happen across all ways of financing, whether it's public financing, whether it is private financing. And this is what we're seeing, the pressure that the investor community and maybe activists are putting on listed companies. There is a risk that we will see assets, the highest polluting assets, actually transition from one set of ends to other sets of ends, and those ends will be a little bit darker, a little bit more shadows around, less transparency, less visibility. And so what activists are doing, I'm just giving a little tip of what we experience, they're trying to find a way to get to those assets in other modalities. One way is through companies like mine, through the insurance sector, or through banks that lend money or to provide capacity for those assets to be able to operate. And to say, well, what are you doing in your decarbonization of all of your activities? The second thing that you will see is legal redress. And everyone on the call may or may not be familiar, but I will quote the recent adjudication in the Netherlands against Royal Dutch Shell, where they were found not to have complied with their obligations. And there is, I'm not going to open a big legal debate here, but there is a very new legal discipline that is forming that is going to put up a pressure, and that is independently of whether you're a listed or not listed company. So I just want to say, it's super important that transparency is part and parcel of how we take decisions, and it's completely worth investment at this point.
Thank you, Veronica. And I realize that we probably have many questions from the audience, and I also want to leave time for that. But one more question to our expert panel I wanted to raise before. And this has to do with the fact that one thing that was decided at COP was to move the nationally determined contribution plans from 2025 to 2022. What are the implications of this sort of fast forwarding of kind of nationally determined budgets, if you will? Do you think for companies specifically, and for those of you that are investors specifically?
Yeah, I'd be glad to make a quick comment. My observation from COP is that the financial markets are way ahead of the politicians. You know, because we are fiduciaries, and we have to, you know, both, you know, for CalPERS, as I said, we've got 2 million people relying on us getting this right. For every dollar we pay out, 55 cents come from investments. So we can't hang around waiting for politicians to hug and kiss and make plans. The fact that the COP will meet again next year, and our thanks to Egypt for hosting, is a recognition that COP in Glasgow had too much unfinished business. And the final wrangling on coal, on subsidies, the lack of sufficient progress on carbon pricing, the financial markets who were represented at Paris in 2015, and I was there to speak for a network of investors, and we were calling for these things, and 6 years later we don't have them. We want the risk reporting. We can see some progress, but on the other measures, it's got to happen sooner rather than later. So I think the financial markets at the end of the day are this combination of physics and finance is a powerful mix, but you know, it's a responsibility for all of us as citizens, as consumers, as members of society, as well as in our day job as investors, to make sure we get these political commitments driven forwards. And if you look at the precarious nature of Biden's political coalition, and you look at the pressing issues of poverty and access to electricity in India, and quite separate but complex dynamics in China, this is as much an issue of geopolitical dialogue and development to meet people's basic needs. We can't just see these as neat and tidy plans where one country will do this and ratchet it up. This is such a complex process. However, my view still is money talks, and money is speaking on this, just as it does with everything else. So we need to stick to our knitting as investors and make sure we're driving our investment decisions fully informed by this risk and opportunity that climate change brings. But meeting again next year is essential. And I'm only sad that that will be COP-27 rather than COP-7, because if we'd been talking about these things properly 25 years ago, we wouldn't be in this sense of crisis.
Thanks, Anne. Thank you. Kenneth.
Yeah, I just wanted to second something that Anne just mentioned. I think it is very important that the institutional asset owners and managers look at this as an opportunity, because I think that is, I've seen too many times that too frequently people have been looking at it as a constraint, and it is in fact an opportunity. And I think identifying the key sectors that are going to benefit from this transition will help everyone, and will help Anne make sure that the benefits can still flow to her, to the retirees in California and everything else. But that's a very important point, and I think it's not frequently enough reiterated.
Right, so not just the feasibility, but really the opportunity brought on by the kind of sped up timeline around the COPs. Vivek and then Veronica for final comment.
So just very quickly, I think what we need to take into account when we talk about NDCs and LTSs is the political economy, because the technical solutions to exit coal or to decarbonize are there. But I think there's a political economy which we cannot forget or ignore, because people's lives are dependent. There are vested interests. I mean, I don't know how many people know that the Indian Railways has a different budget than the federal government. They have their budget on a separate day. It's so big. And guess which is their largest source of revenue? It's coal. So if you were to take coal out of the equation tomorrow, The Indian Railways is going to have a huge gap, and they use that money, I think, to subsidize the fares for the poorest. So, there are tier 2, tier 3 things that we need to start looking at, and that's when the political economy kicks in, whether it's in India or in South Africa or in the US. There's a large component. So I think that is something we have to take into account. And we need to work around it. I'm not saying that we need to be, give up on it. Don't get me wrong. But I would just put that out there and then thank all of you all, because I need to leave right now. But great chatting. Thanks.
Thank you so much, Vivek, for excellent contributions. We look forward to being in touch. Veronica, over to you.
I'll keep it to 30 seconds. So I mentioned before, I really do believe the opportunity stands in starting to do the right things first. So removing any market distortions, whether it's subsidies to fossil fuels, or removing the tariffs that prevent us from developing more climate-friendly goods. I think that's very important, and recognizing that we're going to develop globally connected climate markets. I think, considering the nature of the trades that in carbon adjustment mechanisms, that is eventually going to develop. So I would encourage that. The second thing is, on the opportunity side, a real opportunity is incentivizing first movers. We have, as Vivek said, we have somewhat the roadmap for level 1 and 2. We really need the technologies. So having a smaller footprint, polluting less, absolutely, but there is a stock of carbon that needs to be removed, and that requires in part nature and in part industrial level solutions, and that industrial solutions will be a multi-trillion industry. In fact, the same sectors that today are the largest emitters, with the right technological deployment, they could reinvent themselves. And I think this is part of the invitation, right, to continue to look for, and governments can have a huge, huge market signaling power by creating sector-specific policies that really accelerate the creation of those new technologies. And last but not least, I think Kenneth mentioned it before, we have to invest in adaptation, and adaptation will create employment opportunities, will create jobs, will create impact on populations that is positive and tangible straight away. So I don't think it's all loom and gloom. It's just that it just needs a lot of action now.
Right, lots of action, not doom and gloom. So great to end on that note this section. Emily, I want to hand it over to you for any questions from the audience to the panel.
Yeah, thank you. We have a lot of audience questions, a lot of interest, which I always think is a reflection of a fantastic panel. So I am first going to go to Jorge Cecilia Serrano, and I ask that you please introduce yourself, identify your affiliation, and please pose your question. Jorge?
Hello, thank you for the panel. Very interesting panel. Let me say that I couldn't agree more with the
Jorge, we're having a little trouble hearing you. Can you turn up your audio?
Could you hear me?
It's a little bit tough. I'm going to go ahead and pose your question for you, Jorge, since we're having trouble with your audio. And Jorge's question is to our panelists: do you think that the moral suasion approach, kind of the voluntary approach to the Paris Agreement, is an effective way to tackle climate change instead of a more maybe compulsory approach among a coalition of, countries who are willing? So kind of, high level, is this the right way to tackle it on a voluntary basis? And I think that there's a lot of questions here also on kind of how do US politics play into this approach as well? Several audience questions there. So maybe Ken, maybe we'll go to you first on that, and then other panelists can jump in.
Look, I think that we've already seen the evidence that even in countries in which the authorities purport to be willing and to join in, the domestic political environment immediately can begin to put pressure on. And we've seen there is in some countries there's a lot of money in politics, and you begin to if your commitments undermine someone's perceived economic position, then they're supporting your opponents in the next election. And there are other cases in which it's just the very direct impacts. And I'm thinking, you know, this came up before, but the impacts of a lot of these measures are disproportionately on the less well-off, and that can create a lot of problems. I think there is, at some point, to the extent that it's going to be political solutions that are going to help this, there is going to have to be some kind of really enforceable measures that go across national boundaries to get consensus on this. But this is hugely complex to get that done.
Veronica or Anne, any follow-up there?
I'll give a very, very quick, maybe a good example to follow, but still to be tested, is the European Green Deal approach. I think because they've adopted an holistic set of principles that are now binding the member states. They are creating the framework for more transparency, accountability, and comparability of the nationally determined contribution targets by the member states. They're creating the conditions for financing through the recovery funds that have been disbursed. And they're creating sector level policies, for instance, on hydrogen, that should help. Now, do we have full enforceability of European directives in the EU? Absolutely not, and that's where Kenneth is absolutely right. Whether it's Europe or federal states organized, it is very. It's always, you know, the execution is where the proof of the pudding happens. So, but I would say that political conviction and the fact that so many countries within the European Compact could come to that agreement should inspire, I hope, other regions to move. I actually expect China, they tend to commit low and overachieve. I expect China, having made their commitments, that they will stick with it, and they have the, by the nature of their regime, you know, they have the ability to execute it if they so choose. So that to me gives me hope that around the world we will see more momentum. But yes, democracy is messy.
Anne, would you like to comment?
Yeah, thank you. On moral suasion, I think the only person I've heard speaking in those terms is the Pope, who says, you know, to his Catholic community and also in dialogue with other religious leaders, this is a moral issue. For CalPERS, it's a fiduciary issue. And we have an existing legal requirement to be prudent, to act with care, to have exclusive loyalty to the interests of our beneficiaries. And regardless of a moral call to action, our fiduciary duty, taking care of almost $500 billion on behalf of 2 million people, we have to both protect those assets and we have to grow them. And we can't do that without climate change being integrated on the risk and on the opportunity. So just to give you an example on the opportunity side, we looked at where we're invested in climate solutions across our portfolio, and in private markets alone, we have about 20% of our private markets assets in climate solutions. And the example of energy efficiency was an excellent one. But we're also finding, as the owner of properties, the technology opportunities, the private equity, the technology and venture that we've got there, this transformation is producing, you know, deep opportunities across the portfolio. So we have to come to this conversation not talking about moral suasion as individual humans, morality matters, but our fiduciary duty is what drives this work. Regarding the different political systems globally, as I mentioned earlier, we have to work through nationally determined contributions. As Veronica said, the European Union has a way to bring a regional strategy to bear, but most parts of the world don't have that. And it's particularly complicated even in the United States because this precarious balance of power that Biden currently has could just as easily flip in the opposite direction. So we have to have the economics in place. We have to be sure we're clear on the business case, on the investment case, because that is what can weather some of the, I know somebody was asking about volatility in the markets earlier, but political volatility is an understood risk for investors. So keep our eyes on the prize, make everything we do absolutely practical, and make sure that we continue to press policymakers for the risk reporting and for removing the subsidies and imposing the correct pricing on carbon. That will move the markets across the political spectrum. I really believe that.
Thank you, Anne. Yeah, I think we've heard loud and clear today that there is a business case for this, and as you said earlier, that the financial sector is really leading the public sector here. I'm going to finish up with one last question. Just not enough time to get to all of these, but really, really great questions from our audience. I'm going to go to Inigo Bengoechea, who we've talked a lot about energy today and energy pricing and market distortions. He has a good question on kind of the real impacts of energy prices on people. Inigo?
Thank you, Emily. I really appreciate it. And thank you to the panelists for this wonderful webinar. I wanted to ask you about the energy crunch we're seeing in Europe, the US, and other countries. Does this energy crunch pose questions about net zero promises? What do you guys think? Thank you.
Well, I'm happy to kick off with a quick thought. This is about managing the short term and the long term. And it's also puts a premium on competence, because in the transition plans, if we don't make sure that the energy needs of communities are met, and we were talking rightly about India, where and other parts of the world where people don't even have access to affordable electricity, then you've got richer countries coming under and China. Even look at the Texas power grid outage. This question of making sure that people's needs and wants are taken care of, that premium on competence. So there's a lesson that you've got to manage the transition in the short term through the, through to that long-term goal. And I think it was Maynard Keynes who said, the short term is all that matters, because in the long term, we're all dead. Now, as a fiduciary, actually, you have a responsibility to think beyond current generations. But how we manage the short, medium, and long term, to me, is a big pressure point. We've got to think about these transition points, particularly in relation to core dependencies on coal, be that Europe, be that West Virginia, be that India, South Africa, and also Australia. People talk about the global south, forgetting where Australia and New Zealand are. So the these issues of transition are really critical. But we've also got, and I think Ken made the point very well. Politicians are on their own cycle. In a democracy, through the election cycle, and in the Communist Party-led regime for China, and more authoritarian models in places like Russia, you say, well, the advantage of that system is you're going to get things moving fast once they're decided, but you don't have the regular check-in through the ballot box. But as we see in the United States, that can also be quite fragile and complicated in its own right. So we've just got to keep moving this through on the business case for change.
Ken, Veronica, any follow-up comments?
I'll again, super briefly, and thank you for the question. Some of the shortage that we've seen is, so I think it's, first of all, is short-term lived, but we are going into the winter season, at least in the Northern Hemisphere. So we should expect some further nuisance coming from the energy supply and the price consideration. The case in China is interesting. They intentionally switched off as way of producing some of their carbon targets. And then they said, well, we need to balance that with the impact on the population. So it just shows that transitioning is an imperfect exercise. And what is required is a larger stock of renewable energy, non-coal dependent type of capacity production, so that we can avoid this, what I call the blips, right? This kind of little movements in the market. It should be cause for an acceleration rather than a deceleration of our decarbonization efforts. And it's very important that the price of alternative energy comes down, because let's face it, carbon is very poor from a carbon footprinting standpoint, but it's very effective from an energy production and a cost standpoint. And that's the reason why it became so widespread.
Kenneth, final comment?
Yeah, I just wanted to on that point, there are also some notable gaps in our approach to this energy transition. I was pleased to see at COP that there was actually a reasonably good discussion of some of the new nuclear technologies, and bringing which of course you can swap out coal-fired generating plants with some of the new modular technologies and move that forward. But of course, there's still a tremendous, kind of underlying resistance to anything that begins with the N word. But I do make that point because I think we do have to have the full suite of options out there if we're going to make this work.
Yep, agreed. Mario, any final comments before we close out here? We're just a minute over time, so we should wrap up quickly.
I just want to thank everyone for taking part in this conversation. I think that the message that was delivered loud and clear is that the momentum is there, and there's some great efforts at increasing transparency for climate finance that came out of COP. There's also a maturity to some degree of, say, technologies as well as investors' motivation in financing things. We need to get things done in the next year, both in the capital markets as well as in the private markets. And I hope that this actually will be the first and of many in discussions with the Bretton Woods Committee, including, of course, bringing development finance into the picture to make this a wholly global conversation around climate finance that we will continue to work on in the Future of Finance Working Group with the Bretton Woods Committee. So thank you very much, Veronica, Vivek, Kenneth, and Anne for your excellent contributions.
Thank you.
Yes, thank you all. This was fantastic. Looking forward to future conversations. And to our audience, there will be a recording of this on our website. A few people have asked, so we will post it there later today. Thank you once again, everyone, for joining us. I'm sorry we didn't get to all of the questions, but very much appreciate you all joining us today. Thanks.
Bye.
Thank you.
Thank you.